Does volume affect stock price? You probably know that the more shares that buyers demand to buy will affect the price of a stock. So too, the more the supply to sell will equally affect the price of a stock. So it is established that demand and supply affects the price of stocks. Obviously, demand and supply is about volumes. What of aggression? A trading veteran asserts that it is actually aggression that determines the price of stocks. And see what the folks at Forexpedia are saying. Aggressors are traders that take liquidity out of the markets. Rather than entering bids for shares, aggressors buy at market at the current ask price, which is using market orders. They will also sell at the current at market bid prices rather than specifying a selling price, which is still the same market orders. By purchasing available shares or contracts at the current at market prices, aggressors place orders which have immediate execution. Other traders are passive because they add liquidity to markets by entering bids and offers which may not have immediate filling or execution. So aggressors are traders who remove liquidity from the markets by entering buy and sell orders at current at market prices. Because aggressors purchase available shares or contracts at the current at market price, their orders are executed immediately. This immediate action means aggressors sell at lower and lower prices and buy at higher and higher prices, thereby pushing out other traders and taking liquidity out of the market. In contrast, passive traders add liquidity to the market by placing trades with bids and offers, which may not be immediately filled or executed. Because of this lack of immediate execution of their trades or their orders, the markets are somewhat stabilized and minimizes the volatility. So how aggressors affect or rather impact the market liquidity? Okay, by taking the immediate action at the current bid or ask price, aggressors continue to sell at lower and lower costs or buy at higher and higher prices. This squeezing causes volatility, which will become much more common as markets get thin and imbalanced as other traders are pushed out. Volatility in the stock market is associated with big swings in prices of individual stocks. Typically, a volatile stock market is one that prices rise and fall more than 1% over a sustained period of time. So, yes, volume or demand or supply affects prices of stocks, but at the same time, inside all of that is aggression. There's nothing wrong about using market orders. You have to, get your money out, get in fast, get out fast. It's up to you to do that. But this is ultimately how, amongst other things, how the prices are determined to some extent. There are indeed other factors, but inside that demand and supply, inside that volume that affects the prices, you have aggression. That aggression also affects things. So see what you make of all of these things, and thank you very much for watching this